So welcome to today's class. This is MAC 3701, revision class 2 of 3. So last week in class 1, we dealt with, we busy with the MAC 3701 October-November 2018 question paper. We covered part A, part B, and part C. Today, we're gonna deal with part B. So part B is a big focus. I'm gonna take my time on, it's not part B, part D. So I'm gonna take my time on part D, because part D is a big focus area. So, so that is a big focus area. So I want to take my time on part D. If you have time, we're going to do part part F. So part D says, using your calculations in B and C, prepare MB's statement of profit or loss and other comprehensive income for the month of October 2018. So remember, when it comes to management accounting and when it comes to management accounting or cost accounting, when you read a question, try to identify 3 things. Whether they want actual budgeted information, what date, and then the period. Is it 1 month? Is it 1 year? Is it 1 quarter? So in terms of the period is October 28. In terms of the date, it's October 2018. The period is a month. So it's for the month of October 2018. And then we need to identify whether we want actual or budget. They said based on B and C. B and C is based on actual information. So therefore our income statement is going to be based on actual information. When we prepare income statement in management accounting, in cost accounting, we need to ask ourselves, what is the costing system? Is it a variable costing system or is it an absorption costing system? So let's just check again what system they're using. I can't remember.
Absorption.
So they're using an absorption costing system. So therefore your income statement needs to be based on an absorption costing system method. Remember, the difference between an absorption costing system and a variable costing system is the treatment of fixed manufacturing overheads. So the difference between the absorption costing system and the variable or the direct costing system is the treatment of fixed manufacturing overheads. Under the direct costing system, fixed manufacturing overheads is expensed in the year it is incurred. Whereas fixed manufacturing overheads under the absorption costing system is added to the cost of inventory. It is capitalized to the cost of inventory. So that means the fixed manufacturing overheads is only expensed in the year the inventory is sold. So on the direct costing system, when the fixed manufacturing overhead is incurred in that year, it is expensed. Whereas for absorption costing system, the fixed manufacturing overhead is only expensed when it is sold. Why? Because fixed manufacturing overhead is added to the cost of a product, it is added to the cost of an inventory, it is sitting on the balance sheet, and it only hits the income statement when a sale is made. So that is basically the difference between the direct versus the absorption costing method. So now I'm going to switch over to the Google Sheets. So you should be able to see Google Sheets, and I'm going to deal with question D. So remember, we did Q1A, Q1B dealt with Q1B as well as Q1C. This here is Q1C. Okay, question 1C. So this here is Q1C. Now we're going to deal with question Q1E. D. Q1D. Excel not visible. Okay, should have been. Let's just check. You see it now? Okay, so Q1C. So we said we dealt with Q1A, we dealt with Q1B. In Q1B, there's also Q1C. And now we're going to do question D. Okay, question 1D. So we want to do an income statement. Okay, so when you want to do an income statement, always identify which costing system you are using. We are using the absorption costing system, so the way we set up the income statement will be different to the way you set up the income statement from a direct costing system method. So what we will have sales less cost of sales, okay, less cost of sales. When you want to do cost of sales, set it up as follows. You want to start off with your production costs. So your production cost, the cost of inventory is made up of three things: direct material, direct labor, manufacturing overheads. Manufacturing overheads have two parts, variable and fixed. Which of those you include depends on the costing system. Because we are using the absorption costing system, we're going to include both manufacturing overheads, both fixed and variable. So your cost of sales is made up of direct material, direct labor, variable manufacturing overheads, fixed manufacturing overheads. What's important to take note, you don't exactly want to write it out like this. You might just run it through your mind like that. Because remember, the way they present the information may be slightly different. So I'm going to leave it like that for now, but when we do the question, I may change it to represent, because for example, if I remember correctly, they never gave us direct material and direct labor, but they gave us prime costs. Prime costs is direct material, direct labor. So instead of saying direct material, direct labor, we will change it by saying prime costs. So what's important, it is your thinking. Your thinking is that the cost of a product is direct material, direct labor, manufacturing overheads. Which manufacturing overheads depends on the costing system. Because we're using the absorption costing system, the manufacturing overheads is both variable and fixed. Okay, so that's important to take note. But before you write it down in that manner, you must have a look how the question is presented. How did they give us direct material? How did they give us direct labor? How did they give us manufacturing overheads? So if I remember correctly, let me just go check. So I don't quite remember, I have to work through it. But basically, okay, so they split it up. So what's important, you must see how they gave you the information so that we can set up direct material, direct labor in the manner that they gave it to us. But I'm going to leave it like that for now, and we will fix it up as we go along. So that is the production costs. But now with cost of sales, we must also take into account any opening inventory, and then any closing inventory. So I'm going to say opening inventory, as well as any closing inventory. Okay, so this will make up the cost of sales. Okay, so that will make up cost of sales. So now that we have cost of sales, we will now be able to say sales less cost of sales will give me gross profit. So sales less cost of sales will give me gross profit. Okay, now that we have gross profit, now we can take other costs into account. The other costs would be variable non-manufacturing overheads or costs, and then fixed non-manufacturing overheads or fixed non-manufacturing costs. I'm just writing it like that for now. We can change to the actual words that they use, the actual costs that they use when we read the scenario again. So then this gives me profit or loss. So this will give me profit or loss. So that is basically the template. Okay, so we will change to the actual terminology based on the scenario. So now I'm going to go back to the question. I just want to read it again. So let's understand what they asked us. Using B and C, prepare MB's statement of profit or loss and other comprehensive income for the month of October 2018. So we're busy with the month of October 2018. So the date is October 2018. The period is 1 month. And then whether it's budget or actual, it is actual information because B and C is based on actual information. So just take note of that. So now we can prepare the income statement using, so we're going to use part B and part C. So just take note of that. So I'm going to read I'm going to read MB again because we're busy with MB. So I'm going to read the scenario again just to remind us, and then we will work through it together. So they say MB was UB's first bakery. This bakery operates a process costing system in the manufacturing of the savory cheese biscuits. The SCB's manufacturing process begins with the mixing of the direct raw materials, which is flour, butter, cheese, and eggs, followed by the kneading of the dough. The dough is then cut into the required forms and baked. The baked biscuits are cooled and packaged into individual packets of 500 grams each, which represents 1 unit of SCB. These units are packed on pallets for distribution to various supermarkets. Each pallet packs 48 units of the SCB. So remember, 1 unit is 500 grams or 0.5 kilograms. Okay, so whichever way you want to look at it, and take note that each pallet is made up of 48 units. So they say all the direct materials required to manufacture SCB are added at the beginning of the manufacturing process. Direct labor and manufacturing overheads are incurred evenly throughout the manufacturing process. So what's important to take note, they're using a process costing system, right? Right on top, they told us they use absorption costing system. So an absorption costing system tells you which costing method they're using, how do they treat manufacturing overheads. The process costing system is just basically how do they cost a product, okay? Now, they're telling you that at the beginning of the manufacturing process, they include direct material. So that means immediately all direct material is added, and throughout the period, they incur direct labor and manufacturing overheads. But we explained this in last week's lesson. So if you want some more details, you can watch last week's video. They say 1 kilogram of the direct material yield 1 kilogram of biscuits. Normal losses in the form of broken and rejected biscuits amounts to 6% of the direct raw materials used. These broken and rejected biscuits are identified at the 80% completion point of the manufacturing process. All broken and rejected biscuits are sold to bird breeders at 10 Rand per kilogram. Actual information for the month of October 2018 was as follows. On 30th September 2018, there was 200 kilograms of work in process, which was 60% complete. The direct raw material cost included in work in progress was 4,000 Rand, and the direct labor and manufacturing overheads was 6,000 Rand. So basically your opening inventory is basically 10,000 Rand, okay? 1.3 tons of direct raw material costing 25,000 Rand were added into the process. The current direct labor and manufacturing overheads totaled 75,300 Rand. 2,200 units were completed in the month. On 1 October, 270 kilograms of work in progress were 90% complete. All completed units were sold in the current year at a selling price of 80 Rand per unit. There were no opening and closing inventory. There were no opening and closing finished inventory. MB only uses far and wide to distribute the biscuits to the supermarkets. The agreement with F&F stipulates that a fixed monthly fee of 5,000 Rand plus a cost of 100 Rand per pallet transported. Okay, so we're gonna have to work out those costs. So there's a distribution cost, which is fixed and variable. Then they will say MB's office equipment was bought on 1 August 2015 for 130,000 Rand and immediately brought into use on this date. Immediately brought into use. On this day, the equipment's resale value was estimated to be 10,000 Rand at the end of its useful life. The equipment is depreciated monthly on a straight line basis over its 5-year useful life. Okay, so there we can go. So I'm going to deal with 2.8 and 2.7 because those are easy marks. Okay, besides for the variable one, we'll have to work out on that. So let's go back into the question. So now I'm going to deal with my workings. So working one, we're going to work out depreciation. To work out depreciation, you're going to say cost price. You're going to say residual value. And that's going to give us depreciable amount. So this is 2.8. Okay, so the information from 2.8, we can work out cost price minus residual value, give you a depreciable amount. Depreciable amount. So the way you use a straight line method, you say cost price minus the residual value gives you depreciable amount. You take the depreciable amount and you divide it by the useful life. Okay, once you get the useful life, you will get your annual depreciation. You will get your annual depreciation. We don't want annual depreciation. We want depreciation for a month. Okay, so then we can get depreciation for a month. Depreciation for the month. Okay, so then we can get that. So now if we go back to 2.8, so we have, so they said it was bought on 1 October for 130,000 Rand. So the cost price is 130,000 Rand. The definition of a residual value in terms of accounting, the residual value is considered to be the amount that you can receive for the asset at the end of its useful life. So the residual value is the amount you can receive for the asset at the end of its useful life. So they said on this day, the equipment's resale value was estimated to be 10,000 Rand at the end of its useful life. That is its residual value. So the residual value is the amount that you can sell the asset for at the end of its useful life. So that is 10,000 Rand. So now we can say cost price minus residual value gives you 120. Useful life, I think I read 5 years. Useful life is 5 years. So the annual depreciation is 120 divided by 5. Okay, but we don't want annual depreciation. We want depreciation for the month. So all we can do is say annual depreciation multiplied by 1 divided by 12. So your depreciation for the month is 2,000. Now, depreciation is considered to be, let me just see quickly. So remember, that is office equipment. Okay, so office equipment is not part of the manufacturing process. Office equipment is not part of the manufacturing process. So this fixed depreciation is a fixed cost. The question is, what type of fixed cost? Is it a manufacturing fixed cost or is it a non-manufacturing fixed cost? Because we are dealing with an office equipment does not form part of the manufacturing process. So therefore, it is not a manufacturing cost. So therefore, this fixed cost is a non-manufacturing cost. So over here, we can change fixed costs. So what I'm going to do, just to, you don't have to do this in the exam, right? Just to give you some perspective when you look at it, that this fixed manufacturing, non-manufacturing cost is depreciation, okay? So depreciation, you can just write depreciation, that's fine. But I'm just telling you that it's a fixed non-manufacturing cost. And I'm saying, what is it? It is depreciation. It is equal to 2,000 Rand. So this here is working 1. So that is an easy marks. Then we're going to deal with 2.7. So they're saying MB only uses far and wide to distribute the biscuits to the supermarket's central warehouses. The agreement with far and wide stipulates that a fixed monthly fee of 5,000 Rand plus a cost of 100 Rand per pallet transported. So now you can see that distribution cost has both a fixed and a variable component. Because its distribution is not part of the manufacturing process, therefore it is a fixed non-manufacturing cost. So say like depreciation, I'm going to call it fixed non-manufacturing costs. But now I'm not going to say depreciation, I'm going to call it distribution. There's no need to calculate anything. They told us it is the fixed cost is 5,000 Rand per month. So here I'm just going to say given. Okay, but now we need to work. Is there a question? Yes, Danielle? I can't see this. You can't see the share. Abby, do you see the share screen? I'll stop it now and I'll reshare, but Abby, can you see me? Just hear Abby say. So Abigail can see. Is on from your side, because my thing is full screen. Is your thing on full screen? I'll stop and I'll reshare. And how do you see now? Abby, do you see it full screen? Because from my side, I can see my screen is on full screen. Yeah. Okay. So remember, with the depreciation, it is a non-manufacturing cost because so depreciation is a fixed cost, but is it manufacturing or non-manufacturing? Because the depreciation relates to office equipment, it is non-manufacturing, therefore it's below the gross profit line item. Distribution is a non-manufacturing cost. Distribution does not form part of manufacturing, and therefore it's also below the line item gross profit or distribution. Now we're going to deal with variable. Now we're going to deal with variable non-manufacturing cost, which is also distribution. Okay, so remember what they said. Working 2. Okay, so they said that they charge 100 Rand per pallet. And we know each pallet uses 48 units. And remember, one unit is 500 grams. So just very important to take note. So here they're saying the agreement stipulates a fixed monthly fee of 5,000 Rand plus a cost of 100 Rand per pallet transported. We know that each pallet has 48 units, okay? And they're only transporting completed units. In October, under point, where did I see that now? In October, under point 2.4, they're telling you that 2,200 units were completed in the year. So remember, each unit is 500 grams. So now we know the number of units. Okay, so we know the number of units completed. So we will say number of units completed is 2,200. But now remember that the variable transport cost is not based on number of units, it is based on the number of pallets. So to get the number of pallets, we must divide how many units per pallet. Okay, so now we can say number of units per pallet. We know each pallet can take 48 units. So if there's 2,200 units and each pallet takes 48 units, that tells us how many pallets we require. So this will give us the number of pallets. So remember, the transport company only transports completed goods because we're not going to distribute to our clients incompleted goods. We're only going to distribute to clients completed goods. We know that they told us how many units were completed. We want the number of units, so we take it as is. But our objective here is to calculate the cost, the variable distribution cost. And the variable distribution cost is 100 Rand per pallet. We know the number of units. We know the number of units each pallet uses, so that will give us the number of pallets. So that's what we're doing over here. So now we can work out how many pallets we require. So therefore, it is 45.833 pallets. But remember, they don't charge us on a 0.833 pallets. So therefore, we must round it up. We can't have 45 pallets. Because if we have 45 pallets, we can't distribute 2,200 units. So in order to distribute 2,200 units, we're going to have to get to 46 pallets. So just take note of that. Okay, so we have 45.83 pallets, but we can't have 45, we have to round up. So therefore, number of pallets. So remember, you need to apply logic that they're not going to charge you for a 0.83 pallet. They're going to charge you for the full pallet. So the number of pallets is actually 46. Okay, so now we know cost per pallet was 100 Rand. So now that will tell you what is the variable distribution cost. Variable distribution costs. So this is going to be 46 number of pallets times 100 Rand per pallet. So that is 4,600 Rand. So over here, I'm going to put in variable non-manufacturing overheads or non-manufacturing costs, variable non-manufacturing costs or variable non-manufacturing overheads. I'm going to say distribution. So this is going to be 4,600 Rand. But I just want to make something clear to you so that there's no confusion. You could have I'm just putting those variable and fixed there, just so you can see the thinking process to show you that when you use absorption costing system, you have sales less cost of sales, which gives you gross profit. Below gross profit, you will have variable non-manufacturing costs and fixed non-manufacturing costs. That's why I'm just showing it like this. But all you could do in this scenario is simply say variable distribution, fixed distribution, depreciation. Okay, you just have to write it like that. I'm just including these capital letters so that you can see, just so you can understand the logic of the variable, of the absorption costing, the income statement using the absorption costing method. So just take note of that. Okay, so there we did all of that, and they're telling us all completed units were sold in the current month at a selling price of 80 Rand per unit. There were no opening and closing finished inventory. Okay, so we can work out sales. So sales, we know the number of completed goods. So we know the number of completed goods. Okay, and then we know the price per selling price. We know the selling price per unit. Selling price per unit. Let's check what I read now. Selling price per unit, where did I see that now? 80 Rand per unit, 2.6. So it's 80 Rand per unit. So now I can get sales. So here we have sales, which is going to be going to be 2,200 times 80 Rand. So sales is 176,000 Rand. This is C36, C36. So sales equals C36. It was working 3, right? Working 3. Okay. Now we get into the important ones. Okay, so now we need to get into the important ones. So opening inventory. So remember, cost of sales, just so you can see the formula. Cost of sales equals opening inventory plus production minus closing inventory. Okay, so opening inventory will be positive. It is the 4,000 Rand plus the 10,000 Rand. Okay, so it is the 4,000 Rand plus the 10,000 Rand. Then, so it's a 4,000 Rand plus the 10,000 Rand. They're telling you that direct material costs 25,100 Rand. So direct material, 25,100 Rand. Then they're saying 25,100 Rand. Then they are saying that the current labor and manufacturing overheads totaled 75,300 Rand. Now remember, current labor, so labor plus manufacturing overhead is known as conversion costs. So therefore, all three of this is known as conversion costs. So I'm going to just change that and call it conversion costs. So then we can delete those stuff over here. So just as a side for yourself, just know the following, that prime costs equals direct material plus direct labor. Conversion costs equal direct labor plus manufacturing overheads. So just be aware of that. That is why I'm telling you, when you think of the cost of a product, run through your mind that the cost of a product is direct material, direct labor, manufacturing overheads. Which manufacturing overheads? It depends on the system. So because we're using absorption costing system, manufacturing overheads will be both variable and fixed. That must be in your head. But before you write it down, you must have a look how they presented the question. Did they give it to you in those 4 line items, or did they combine it in some way? Okay, so that's very important to understand so that you don't waste time. So before you write it down, look at the scenario to see how has direct material, direct labor, and manufacturing overheads be presented. In this scenario, direct material was given, but they never gave direct labor manufacturing overheads as separate line items. They gave it as one line item called conversion costs. Okay, so just take note of that. I cannot remember what I saw, 75, 300. So that is 75, 300. Okay, so our conversion cost is 75, 300. Now we must get our closing inventory. Now this is where we're going to use closing inventory. They said use B and C. So in B, our closing balance is 540. Okay, so our closing balance is 540. Our cost per unit based on C is 34.39. Okay, 34.39. So therefore, my closing inventory, I'll tell them to look at working for. Okay, so if you use working for, closing inventory, it is number of units, and then equivalent cost per unit. Equivalent cost per unit. So this is going to come from Q1B. This is going to come from Q1C. Okay, that's going to come from Q1C. So even if 1B is wrong, even if 1C is wrong, because you're correctly using it over here, you're going to get the marks over here. You will just lose the incorrectness in 1C or 1B, but you won't be, they won't penalize you going forward. They will penalize you, let's say if 1B or 1C or both 1B and 1C is wrong, and you bring in other numbers that is not 1B and 1C, even if the numbers you plug in here is 100% correct, they're going to mark you wrong because they expect you to bring in 1B, 1C. So just remember that. Even if 1B, 1C is wrong, carry it through because they're marking you on principle over here. They're not marking you whether the number is right or whether the number is wrong. They're marking you whether you know you must bring in 1B and whether you know you must bring in 1C. Okay, so very important. If you're carrying numbers through, don't always use your the number you calculated. Don't recalculate the number unless they ask you to recalculate it. Because if you don't bring in the number from your previous calculation, they will actually penalize you. Even if the 1C is wrong, bring in the wrong 1C. Okay, so very important, very, very important. So that's 1C. That is 1B. So there we go. Now we can work out closing inventory. Am I looking for? It is that. So closing inventory. It is going to be that multiplied by 34. Okay. So this here is C38. So this here is equal to C38. And now remember the formula. Cost of sales is opening balance plus purchases or production minus closing balance. So therefore, this must be negative. So if I add up cost of sales equal sum, the add up cost of sales is 95. So therefore, gross profit, sales minus cost of sales, and then profit is equal to gross profit minus minus all the other costs. I think there's just one thing I need to do. I just need to check. There's one more thing I need to do. There's just one more thing I need to do. Just trying to think. Oh, yeah. So we dealt with that. We dealt with that, dealt with that, dealt with that, dealt with all of this. But there was one more thing, I think. Let me just see quickly. Okay. So that you will do. Okay, so what's important to take note over here is that they told us that, what did they tell us? They told us that we can sell the abnormal goods. So just have a look over here. Yeah. So they told us somewhere here. Where did I read it now? Yeah. So if you look at the last paragraph above actual information, they said 1 kilogram of the direct raw material yields 1 kilogram of SCB biscuits. Normal losses in the form of broken and rejected biscuits amount to 6% of the direct raw materials added. These broken and rejected biscuits are identified at the 80% completion point of the manufacturing process. All broken and rejected biscuits are sold to bird feed breeders at 10 Rand per kg. Okay, so if we go to 1.B, if we go to 1.B, okay, if we go to 1.B, here we have the normal loss and abnormal loss. So therefore, we have 260 units. We have 260 units of broken biscuits. Okay, so remember that we're working on in physical units. So here we have so our broken biscuits, which is normal and abnormal. So working 5, our broken biscuits is our normal loss units and units. And it is our abnormal loss units. Okay, so now we can have a look. It's going to equal to the number of units, which is 156 and 104. So the lost units, which is our broken biscuits. So loss units, just so you know, i.e. broken biscuits. Okay, so it's number of units. Okay, so the number of units is equal to the sum. But now remember, we don't want number of units. We want number of kilograms because the price is 10 Rand per kg. We know each unit, so we're going to say kgs per unit. We know each unit is 500 grams. 500 grams is basically 0.5 kgs. So therefore, the number of kgs, the number of broken kgs, number of loss kgs is going to equal number of units multiplied by 0.5 kgs. So therefore, we have 130 kilograms. So now we know price per kg is 10 Rand. So now we know sales from loss biscuits or broken biscuits. Let's just call it broken biscuits. So the question is, where do you want to put this in? Broken. There's one of two places you can put it in. Okay, so I'm just to make it easy for now, I'll put it in the easier place. So it's 1,300 Rand. So there's one of two places you can put it in. You can either reduce cost of sales with it. You can either reduce cost of sales or you can increase sales. Okay, I'm going to put it by sales. Technically, you'll probably put it, most companies will most likely put it against cost of sales. Okay, but shouldn't have a problem. So working 5, it is C46. So I'm just going to go here and I'm going to say plus C46, and then I'm going to say working 5. Alternatively, where can you put it? Working 5. Alternatively, where can you put it? Somewhere here in cost of sales. Okay, so you can have a line item and say sales from broken biscuits. You can put it in cost of sales, doesn't matter. So you either increase sales or you reduce cost of sales. Most would reduce cost of sales. I'm just putting it under sales, doesn't matter. Okay, so that is part. So that is basically part D. Question D, the profit or loss for 20 marks. Okay, so I mean not for 20 marks, for 12 marks. So that is what I come up with. If you did it before, I don't know if you have a different answer, you can let me know. But before we move on to part F, do you have any questions? Abigail, do you have any questions? Danielle, any questions? Okay. Anything confusing for you, Abigail? Okay, so you're fine for now. Danielle, so the process costing, so this is basically it. So in the, we did this last week. So in the, I don't know if you watched the video. So it's covered in the video, but that is basically the process costing. Any questions, Danielle, on it? Okay, so now we're going to deal with one point. Let's just see what is 1E. So 1E said, with the imminent retirement of Miss Ugogo Baker, briefly explain to her 2 daughters 5 benefits of divisionalization, the 2 bakeries, with each daughter independently managing 1 bakery. Okay, so you can read up on those. There will be probably like 5 reasons in a textbook or something. I'm going to go on to part F. If you have any questions on it, we can deal with it afterwards. So I'm going to go to part F, where they say, recommend to UB whether or not the special order from the new mill should be accepted. Support your recommendation with the appropriate and relevant calculations. Okay, and they say ignore qualitative factors. So the special order, I think, was point number 3. Okay, so it was point number 3. So in point number 3, they read as follows: wheat flour purchases and inventory management thereof. I think it's this one. We just read it again. Yeah, from new mill. Okay, so let's have a look. They say UB's centralized procurement function is fully responsible for the wheat flour inventory management. The company currently uses the economic order quantity technique to manage all its wheat flour requirements. the wheat flour used in both Middelburg and Imalani bakeries is purchased in bulk from Golden Mills. UB uses approximately 24 tons of wheat flour annually in the manufacturing. Manufacturing takes place evenly throughout each financial year, which consists of 300 days. Wheat flour is currently purchased at 8 Rand per kilogram. Safety stock amounts to the manufacturing requirements of 3 working days. The estimated cost to place one order amounts to 1,200 Rand. Direct inventory holding costs, excluding the required annual return on investment in inventories, amount to 5 Rand per kilogram. The current required return is 6% per annum, and the current EOQ is 3,000 kilograms. Okay, so I'll tell you what we will deal with this now. Okay, so that is basically it. Then they say UB has been approached by another wheat flour new mill, offering a purchase price of 7 Rand per kg, provided that the orders are placed in batches of 1,500 kilogram per order. New mill is situated further from the bakeries, and as a result, the ordering costs will increase by 50% per order. So basically, in a question of this nature, they're asking you for the following. They want you to compare the total costs from ordering from Golden Mills versus the total cost of ordering from New Mill. So you will say, okay, if I order from Golden Mill, what is the total cost of inventory? If I order from New Mill, what is the total cost of inventory? And you choose the one that is the cheapest. Okay, so you will set it up as follows. Where am I now? So you'll set it up as follows. So 1F. Okay, not sure what's happening. Here we go. So remember, all you want, you're just going to compare the cost from Golden Mill versus the cost from New Mill. That's it. Okay, so the way we do it is as follows. Details. It is simply going to be purchase price, purchase costs, ordering costs, and holding costs. Okay, we will leave a space just in case we need to include another cost, and it's easy to actually insert a new cost that we may miss. Okay, so this will be total costs. And all we will do over here is put in here Golden Mill and New Mill. Okay, so that's all we're going to do. And then we will compare the pricing. So whichever one is cheaper, you will go with that. Because remember, they only asked you from a quantitative point of view. They said ignore qualitative factors. So if they want qualitative factors, you still do the quantitative analysis, like this calculation over here, and then you compare from a numbers point of view. But then before you make a final decision, you must consider qualitative factors. In this case, they're not asking us for qualitative factors. They just want to know, should we go with Golden Mill or with New Mill, only from a quantitative point of view. So therefore, okay, so to answer the question, it will be as follows. They said in 1.4, in F, Recommend to UB whether or not the special offer from New Mill should be accepted. Support your recommendation with the appropriate and relevant calculations. Okay, so we will have to conclude on that. So we'll leave a space for that, and then we will now I will do calculations. Okay, so now let's have a look at the various calculations. Okay. So what you want to do first, try to get the purchase price. Okay, so remember how many, so what do they use? So they say UB's centralized procurement function is fully responsible for all the wheat flour inventory management. The company currently uses EOQ technique to manage all its wheat flour inventory requirements. The wheat flour used in both Middelburg and Imalani is purchased in bulk from Golden Mill. UB uses approximately 24 tons of wheat flour annually in their manufacturing. So remember 24 tons, we want to convert that into kilograms. So last week, Alvina made mention that that 1 ton, according to Eunice's notes, is 1,000 kilograms. Okay, so to convert that, we're going to say 24 tons times 1,000 will give us the number of kilograms. Manufacturing takes place evenly throughout each financial year, which consists of 300 days. Wheat flour is currently purchased at 8 Rand per kg. Okay, so wheat flour is currently purchased at 8 Rand per kg. What is New Mill offering? New Mill is offering 7 Rand per kg. So therefore, we can work out the number of kgs. Okay, so if I go back, so though you're working one, we can do the following. So we will say number of kgs, number of annual kgs. Okay, so we know it's going to be 24 tons times 1,000 kilograms per ton. So it's 24,000 kilograms. Okay. Then we're going to say cost per kg. So maybe if I just want to, I'm just going to do it a little bit more detailed. Just so if you can work through the question, it's easy to follow. But you can just start in an exam. You can just start over there. Okay, I'm gonna add the two just to do the conversion. $24. Okay. Kgs per ton. 1,000. So that will give us our number of kilograms. So number of kilograms is going to be 24 times 1,000. Okay. We know the cost per kg. For them it is 8. For them it is 7. Okay. So therefore, purchase costs. So therefore, cost price. So there we go, purchase costs. So for them, it is 24,000 multiplied by 8 For them, it is 24,000 multiplied by 7. Okay, so we go over here, 192. And over there, it is 168. So that they working one. Now we can work out ordering costs and we can work out holding costs. Okay. So we can work out ordering costs and we can work out holding costs. So ordering costs is as follows. Working to ordering costs So ordering costs equals cost per order multiplied by number of orders. Okay, just so you can know, number of orders equals number of orders would equal total quantity divided by quantity per order. Okay, so just be aware of that. So it is number of orders is total quantity divided by quantity per order. So I'll show you now. So we want to get number of orders. So what we will, to get number of orders, we will let's say number of orders. So number of orders, and then costs per order. Okay, so number of orders, cost per order. And that will give us our ordering costs. So we know the cost per order. It's going to remain the same for both companies. They told us the estimated cost to place one order amounts to 1,200 Rand. And then they say the ordering costs, the cost per order for new mill is 50% higher, right? So cost per order for golden mill is 1,200, and then this is going to be 1,200 multiplied by 1 plus 50%, which is 50% higher. Okay, now I must get the number of orders. So you can see for windmill, we must use the EOQ. They told us that EOQ is 3,000 kilograms, right? So generally, your number of orders is total quantity divided by EOQ. So just take note. When you use the EOQ, when you use the economic order quantity technique, your number of orders is equal to the following: total quantity divided by EOQ. Okay, so just take note of that. So it is generally going to be EOQ. So we know the total quantity. So we know total quantity, okay? So we know the number of kilograms. And then we're going to say kilograms per order. Now, this is the important part that you need to take note. This is the important part that you need to take note of now. Okay, so this is number of orders. So with Numal, they came and they're telling you how much quantities you need to place per order. So for Numal, they're telling you that this is the arrangement. We will charge you 7 Rand per kilogram, but we require you to place 1,500 kgs per kilogram. Okay, so they're telling you, they are telling you how many kilograms per kg. Okay, so that's important. With golden mill, they're not telling you how many kgs per kilogram. So with new mill, they're telling you we're going to charge you 7 Rand per kg, provided that each order you order 1,500 kgs. Whereas with new mill, with golden mill, sorry, they're not telling you how many. They're not telling you how many kgs to place per order. So the question is, how many should you? And that is where EOQ comes in. Because you are using EOQ technique, you will use the EOQ quantity per order. Remember the EOQ, economic order quantity? EOQ tells you what is the optimal number of units per order. In our case, units is kilograms. So in our case, what is the optimal number of kgs to place per order? So EOQ was given to us as 3,000. So when do you use the EOQ? When a company does not give you a specified quantity, and as a result, you as the company are using, so for example, we are the bakery. We have a relationship with Golden Mill. Golden Mill is not telling us how much kgs to place per order. So what do? We want to know as the bakery, how much should we place? So then we use EOQ. So that is why for Golden Mill, we are using the EOQ quantity, because that is the optimal number of kgs per order. Whereas new mill, why aren't we using the EOQ for new mill? Because the arrangement with new mill is that new mill is telling us how many kgs we should place to get the 7 Rand. Okay, so that's very important. So then we say kgs per, so total kgs divided by kgs per order. So that tells you we're going to need 8 orders for, we're going to need 8 orders when we need to place 8 orders with Golden Mill, whereas we have to place 16 orders with New Mill. So that is C30 and C30. So where am I now? Here. So here we're going to get the ordering cost. 8 times 1,200. 16 times 1,800. Okay. So therefore the ordering cost is the following. So this is going to come to working 2. So ordering costs 9,600. Holding costs, ordering costs there 28,800. Now we're going to work out working for holding costs. Holding cost is calculated as follows. Holding costs equals holding costs equals EOQ divided by 2 multiplied by holding costs per unit per annum. Okay, so holding cost per unit per annum. Then there's another calculation. I just need to look it up. So I need to look up the calculation we need in this case. This one, exclude that annual return story. Then there's one that we have to include the annual return. So I just need to look up the formula. I always forget that formula. So we'll work on it now. I just need to think if I'm doing this correct. Yeah, so that is correct. Okay, so holding cost, that's how we calculate the holding cost. EOQ divided by 2 multiplied by the holding cost per annum. So if you have a look over here, they're telling you direct holding costs amounts to 5 Rand per kg. Okay, so 5 Rand per kg. Then here they're giving us the current required return is 6% per annum. So I need to factor that in. But just, I'm going to ignore that for now. I just need to look in the textbook again, what's the formula. But then to set up, you do the same story. Okay, so we do the same story. We do the same story. We're going to say, holding cost per unit. Holding cost per unit. Remember, unit is a kg, so they gave it to us. And this is going to give costs, holding costs per unit. And this is going to give us basically EOQ, or order, a number of orders per average number of orders. Okay, so this is average number of orders. That is why we divide by 2. The reason why we divide by 2 is we're getting an average. Okay, so remember for, so just to put in brackets over here, average number of orders. So just to put in brackets, it is EO that's why we say EOQ divided by 2. So just to take note, what we are doing, because we're working out a holding cost. A holding cost is taking an annual, so this holding cost per unit is an annual cost. Okay, so this holding cost per unit is an annual holding cost per unit per annum. Okay, so to get the holding cost per unit per annum, sorry, because we're using the holding cost per unit for an entire year. So because we are using the holding cost per unit for an entire year, what we do, we work out the average number of quantities per order. Because the average number of quantity per order gives you basically on average how many units are in storage or holded at a given point in time. Remember, we are not holding 24,000 kilograms for an entire year. Okay, so we're not holding 24,000 kilograms at a point in time. We have 24,000 kilograms for the entire year. So what is in storage? What is being held at a given point in time? So the way we get that is by getting the ordering costs, the units per order, and divided by 2 to get an average number of units on hand at a given point in time, and then we multiply that by when we multiply that by the holding cost, that will give you an annual holding cost for the year. So just be aware of that. Why we divide by 2? Because we need to get an average number of units per year. Okay. So for this one, it is going to be 3,000 divided by 2. For this one, is going to be 1,500 divided by 2. What am I doing over here? Okay, so now what's important, they said the direct inventory holding cost is 5 Rand per kg. Okay, so it is 5 Rand per kg. The current required rate of return is 6% per annum, and the current EOQ is 3,000 kgs. Now there's something we need to do with that 6%. There's something we need to do with that 6% before we go on. Can you just give me 5 minutes? I just want to look up in the textbook. I cannot remember. I now need to do something with it. I don't remember what to do with it. Can you give me 5 minutes? And then I just want to see what to do with that 6% quickly. So I'm just going to press pause here. Okay, the textbook doesn't have it. I quickly Googled it and I kind of remember now. So let's go back to this. So when you have, so in this case, they have that required return. If they didn't have the required return, all we're going to do, we're going to say 5 and 5, and the holding cost would be 1,500 times 5 Rand per unit. Okay, so that it is. Okay, so that would be the cost. So that's important to understand. Okay, so they didn't have that interest rate, that required return, then the holding cost per unit is simply 5 Rand. But in this case, they do have that interest rate. Okay, so when like a required return or an interest rate, whatever. So the holding cost per unit would be as follows. So the holding cost per unit would be as follows. Holding cost per unit plus opportunity cost or interest on holding cost per unit. Opportunity cost or interest rate or interest cost on holding cost per unit. And this will give us the total holding cost per unit. This will give us total holding cost per unit, total holding cost per unit. Now we know the holding cost is 5 Rand. We know that. Okay, so there's nothing complex on that. They told us. But now the question is, what is the opportunity cost? The opportunity cost is simply going to be the following. The opportunity cost is simply going to be the following. It is going to be the holding cost per unit multiplied by the interest rate, which is 6%. Okay. So this here is holding cost per unit multiplied by rate. Okay, so interest rate. The interest rate they gave it was the gave us the required rate of return, which is basically your opportunity costs. Okay, so that's important to take note. So therefore, the total holding cost is just the sum. So what I want you to know, if you're not always going to get that interest rate, it hardly comes in, but I see UNISA likes it. Okay, so I think from a UNISA point of view, it usually comes in, but in generally, it hardly comes in. Like I mean, even Colin Drury's textbook, well, as far as I saw, didn't have it now. So just take note, that interest rate part hardly comes in. So if there's no interest rate, you simply use the cost per unit. But if there is an interest rate as well, like the required rate of return, then it must be cost per unit plus the interest on that cost per unit. So the interest is 6% on 5 Rand, which gives us 30 cents. So the total cost per unit is 5 Rand 30. Okay, so just take note of that. So to complete, we'll plug in. So this is C37. So now go over here. I will equal C37. Can drag it across. So as you can see, the total costs for it is cheaper to go with Numal, because Numal would cost 200,000, whereas with Golden Mill it will cost 209,000 Rand. So they only wanted recommendation based on numbers. Okay, they said ignore qualitative factors. So from a numbers point of view, yes, go with Numal as it costs less than compared with Golden Mill. So that is basically the 10 marks. Do you guys have any questions on that? Abigail, Danielle? Okay, anything confusing from your side, Abigail? Abigail, anything confusing on your side? Oh, sorry. Yeah, so the workings is in the folder. You should have access to it already. So I added you to the Google Drive. So you should have received an email to say that you have access. Then you just click on that and then you will have access to it. Okay, I'll send the recordings just now. It's going to be, I just need to load it up onto YouTube, then I'll send it. Okay. If there's no other questions, we'll end here for today. Next week, we're going to do this whole question. Okay. So next week we'll do this whole question. So I'm going to split it up into 2 parts. Okay. So Sunday will be the last part, but then are you guys, I just need to see, are you guys available on Thursday evening? Then I can do the first part, part A, and then on Sunday we can do part B. So just let me know if you're available, then I can. Probably I just need to check my calendar, but on top of my head, I think I'm available on Thursday. When's the 28th? The 28th is not this week. 28th is not this week. This The 28th. So I'm saying like this Thursday. Yeah, so for me, so yeah, you can just let me know, and then I can, what you call it, let me just see what you guys are saying in the group. Yeah. So what I will do is, if you want, I can bring your classes forward I just need to check my calendar. So I can bring it to Wednesday and Thursday. So if we have Wednesday, the first part, Thursday, the last part, then you can have the whole weekend to yourself. Then you don't have me on Sunday. Would that be better? But in the evening from either 6:30 or 6 o'clock until, if we start 6, we end at 8:30 or 8 o'clock. So from 6 till 8, and then again 6 to 8, or 6:30 till 8:30, 6:30 till 8:30. So let me know, then I'll just check my calendar. Then we can do Wednesday and Thursday, and then at least you have Friday, Saturday, and Sunday all to yourself, and you don't have me. So would that be better with you guys? But I'll confirm, obviously. Okay. Okay, that's perfect. Yeah, so I'll check a bit later after my and then I'll check a bit later, and then I'll get back to you guys. Okay, but most likely Wednesday and Thursday, 6 till, is 6 or 6:30 better if I do select a time? Okay. Okay, so we can decide. I'll have a look, and then we will. I'll confirm a time. So probably Wednesday and Thursday. So we have 2 more sessions as opposed to 1 session on Sunday. I'm gonna do 2 sessions during the week with you, and then we can finish this. What you must do, like some of the MAC3702 guys, they ask questions, ask quite a bit of questions if they're not sure on something. So feel free to ask me questions. You can message me. I may not be able to answer immediately, but I do get around to answer it. So feel free to ask if you have any questions. Like I said, just follow a simple process. Oh, this is what I wanted to do, just reminded myself now, is that let's say you're going to start tomorrow. Just say for argument's sake, you're starting your process tomorrow to study, right? So today already select what you're going to study tomorrow, so that when you come to tomorrow and you start studying, before you start, you spend 15 minutes doing the following thing. Number 1, remind yourself of the key issues of that topic. Number 2, remind yourself of any previous mistakes you made with respect to this topic, so that you can prevent yourself of not doing it again. And then number 3, before you start, tell yourself you want to work as quickly as possible. Remember, the objective is not to work quickly, it's not time. The objective is not time, but you want to tell yourself you want to work as quickly as possible, so that when you do work under time pressure, you will be able to. So when you do work under time pressure, you already have indirectly prepared to work fast. Very important. Okay, so please make sure you do that. So I just want to show you something quickly. I just want to show you something that you can use. You can obviously do your own. You can obviously do your own. Do you see the question paper still? I mean the Google Sheets, right? Because I'm on Google Sheets now. I want to show you something on Google Sheets. So if you don't see Google Sheets, just tell me. I'm not checking the chat, so just tell me if you don't see Google Sheets. So what you must do, you can set up your own way, but this is just a suggested way, right? So you have basically topics, then you have Q1, Q2, so what you do is, after each topic, before you start, so tomorrow you're going to do a question. So you already select the question you're going to do, and you started in over here. So the key topics would be, if I just think off my head, activity, based costing, joint and by products, joint and activity-based costing, joint activity-based costing, joint and by products, CVP, CVP and what I'm going to put, so CVP break even in CVP includes break even, but I want to specifically include it over here, so you know you must cover a break even question. So CVP includes break even, okay, and then you will have standard costing. You would have optimization. You'd have relevant costing. Typical thing of relevant costing is basically a special order. Okay, EOQ was not a relevant costing question. Just so the question we covered now was not relevant costing. Then we have transfer pricing, performance management. So for me, this is like the big topics that come to my mind. Activity-based CVP. Okay, then just normal absorption, then just normal variable and absorption costing, just normal of that. So these are the costing with traditional, with the traditional method, right? So these are the, what you call it. So for example, over here, what did we cover? We covered, oh my head, what did we cover? Let me just see again. In Q1, what did we cover? Yeah. So in Q1, effectively, we covered over here, optimization. So what I would do, I would say October, November 2018. So that is what basically what I would do. So let's say later on you want to cover a question, select it now, plug it in, whichever one you want to plug in. So as you look through what you do, you can see where you're doing too many questions and where you have not done enough questions, and then you just pump up that area. So you don't have to do the entire exam question paper. You just go do that aspect in the exam question paper. Like I suggest, daily, do a 20 marks daily, as opposed to trying to do 100 marks daily. Doing 100 marks daily, yes, you're running through a question, but the question you need to ask yourself, what have you learned? So if you spend that 20 marks, if you can push to 50 marks, ideal. 50 marks is the ideal. But let's say you can't, like if it was me, I wouldn't be able to do 50 marks. So I'll do 20 marks. If you can do 50 marks, push for 50 marks, but don't do more than 50 marks, because you rather want to spend a good time understanding the question. So now you spend 20 to 50 marks per night, and you do a question, and then you identify, and then you'll be able to see what are you covering and what have you not been covering enough of. Remember, you don't have to do the entire syllabus. You do the major topics. These are the major topics. So that is a suggestion. You can obviously see what you want to do. 5 questions per topic, over enough. If you're doing more than 5, or if you're coming to 3 and you're still not comfortable, then from a content point of view, you need to brush up. Then contact me, and then I can see how I can help you. Okay. So do this. I did this for the MAC3702 guys as well. So then now you will see this in the MAC3702 sheet as well, if you go into Google Sheets. And then plug in. So before you select already, you either complete this whole thing now already, or you do the day before the time. And then you say, okay, later on I'm going to do absorption costing. It is in June 2020. Okay, now you know in June 2020, you go and you're going to do that question. Then before you start, you're simply going to say, okay, I'm doing a variable absorption costing question. I'm doing an absorption of variable costing question. What am I going, the key issues is A, B, C, and D. The last time I did a question of this nature, I made mistake 1, 2, 3. Now you tell yourself you don't want to make the mistake again. And then you just tell yourself before you start, I'm working as quickly as possible just to bump up your speed. It's going to work out. And then after 3 days, you have a look where you're at and what you have learned. And then you see what you need to bump up. Like I said, if you can do 50 marks, do 50 marks. I mean, you have like 7 days, so you can put in the extra, you can do that last push. So let's say you had 2 weeks, I would say only do 20 marks. But because you have 7 days, you can go all in for 7 days. It's sustainable for 7 days. So you do 50 marks. Don't do more than 50 marks. 50 marks a day. 7 days of 50 marks is 350 marks, right? So 350 marks is 3.5 papers, plus my paper, it's 4.5. Over enough papers. If that is not over enough papers for you, it means you're not feeling comfortable enough. And if you're not feeling comfortable enough with 4 to 5 papers, then it's then from a content point of view, there's something not right. Then contact me so I can help you. Okay, so remember, if you're doing 50 marks a night, you're going to get through 3.5 papers besides my paper. That's going to be over enough. So you don't have to, so try to do full papers, but if let's say too many papers is on one thing, then go get another question paper, not to do the entire paper, but just to do that one aspect. So try it. It's definitely going to be in your favor. Okay, that's all I wanted to say. Who's this now? Okay, I'll have a look to the, yeah, I will, we might have seen it to WhatsApp. Abby, you already have access to it, right? The number, I'll send it to your WhatsApp email. Okay, so I'll do it now. Okay, guys, so all the best with your studies. I will, later today, I'll update the timing. So then maybe, so Wednesday and Thursday, most likely my mind, I just need to check my calendar. Wednesday and Thursday, 6 till 8. Okay, but I'll confirm later. Okay, bye-bye, guys. I'll see you in a few days' time.